might put a couple of articles out there from the economists. We were talking about replacement rates last week. There were two articles, Don't Panic, Fertility Crash, some really good charts and tables and numbers in here. Interesting article. And then they did a follow-up article. I don't remember where they did it, maybe on their Humanity Will Shrink Far Sooner Than You Think. This was a really good article. You get a graphic that's kind of a little irritating as it freezes the computer. I'll try to put those out there. Here's fertility rates, births per women. There's the 2.1. You can see the whole world is expected to fall. So they're debating, is the world going to hit 10 billion, 9 billion? This article is saying maybe 8.4 billion. So we're definitely slowing down. Some countries are approaching 1. So, you know, it's pretty, so I'll try to put these articles out there as something pretty current. I love The Economist. I highly recommend you getting a subscription. They might have a student version. I read it every week. I love it. Takes you around the entire world. You can see some good insights, what's going on in Nepal right now, or wherever you are looking. Tonight, I want to finish up. We're talking about ethics, and I'm giving you this equity-linked annuity as an example of the complexity of these products. I want to finish that up. We had a little bit to finish up on the industry, life insurance industry. So we'll finish that up tonight and then maybe get into the products. We'll start with the life insurance products. But last week, we were talking about these equity-linked annuities that advertise you get all the upside of the market without the downside. And then we just mentioned a couple of things. What happens if you take dividends out? And what happens if you do monthly averaging? I didn't do a good job last week showing monthly averaging. I should have done a little bit better. But if the market makes, say, 12%, that's a good return, right? But what if it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11? What if it makes 12%, but it does it all in December? Your average is only, it's the average year-to-date return for each month. So if you make 1% every month, then your average is more like 6%, 7%. But it's highly unlikely that the monthly average is going to get you anywhere close to what the market actually gives you. Oops, sorry. Hey, Nathan. I'm going to sue Zoom when I retire because it's whoever thought to get back out of that screen by hitting the escape key as if we don't use the escape key a million times throughout the day. So it makes a big difference, right? Here's your actual return. Here's just shorter. The first graph I showed you was over a much longer period of time. Here's a shorter period of time over 10 years, and it makes a big difference. The S&P may turn your $100 into 463. If you take dividends out, that drops significantly. If you use monthly average. So this group right here can say we have a 100% participation. Does that look like 100% participation? Doesn't look anywhere close to it. So now sometimes it's further reduced by a spread, an expense spread. Could be another 3%. So this graph is before all these other deductions that they have. Two contracts linked to the same index with the same method and same participation can still have significantly different returns. And then to make it even worse, some of them put caps. So if you look at the S&P 500, let's say it averages 8, 9% returns. It doesn't make 8, 9% every year. Sometimes it makes 20, sometimes it loses 10, it makes 23. If you cap it at 10, and I don't know if they show the numbers in here, but they'll give you the numbers. Don't do a graph. If you cap it, it greatly reduces return. So here they talk about it. The effect of annual cap is dramatic. The annualized price appreciation for the S&P was 10%. If we cap it at 14%, that 10% falls down to 5.5%. So we're destroying these returns quite dramatically. Now, I'm not sure the cap does more damage than the monthly average. They probably have about the same impact, so they might offset each other, so it's not as dramatic. So there's probably not another cut in half. So these are pushed for people who want to participate in the market without bearing market risk. That doesn't exist. There's no product that gives you all the upside without the downside. I mean, if you could get all the upside of the stock market and never lose money, would you invest in that product? That'd be a really, really nice product, wouldn't it? So market's up 20%, you make 20%. If it's down 4%, you make 2%. You say, wow, this is great. If it's down 40%, you don't have to worry, you have to make 2%. So how can we compare this? And this is why I say when you're being sold this product, you always ask them, take this product and pretend like I went to Vanguard and put it into one of their 60-40 funds, or put it into an S&P 500 index fund with 40% and treasury notes or something. And that's what I say. Compare it to a simple combination of stocks and treasuries. Vanguard's the best. Vanguard has these funds sitting there, very low cost, a lot of history. I'm quite sure that when you ask them to do that, they won't do it for you because they don't know how to do it. These products are so complicated, they're really hard to go back and actually show you the numbers historically. But that tells you a lot. It's like, well, if you can't tell me that, then you obviously don't understand the product. How can I buy something if I don't know how it's going to perform? So compare it to that. Ask your salesperson for that history. One of the firms that recruits students had a table down here on USA in the business building. I didn't go over and talk to them. I didn't want to make anybody mad, but probably recruiting sales agents with sales commissions. So I don't know if any of y'all stopped by to talk to them. But you could have asked them this question. Do y'all sell economic annuities? How did it perform versus this? And this is what they showed. They say portfolio 60,000 in trips. So they're doing 60% treasuries, 40% S&P 500. They did strips. Why? That just strips doesn't have coupons. So it's a discount note. So you don't have to worry about reinvesting interest. You'll get a similar result if you do it differently with like a Vanguard fund. And here's the results. It's really, really hard to read. So you can see the equity-linked annuity outperforms right there and outperforms right there. Everywhere else, it underperforms. It underperforms 96.9% of the time. You would be better off with the simple product. After 10 years, the treasuries and stocks had a return of $220,000. The equity-linked annuity, $186,000. The difference is when the annuity wins, it wins by $219. When the simple formula works, it wins by $36,650. Even this comparison is overly generous because they assume you held it for 10 years. A lot of people get out of these early. You get out of them early, it's disaster. Because remember that guarantee they told you? The market falls, you might lose that if you surrendered early. And then you have all these tax disadvantages. The returns on equity annuities are taxed at the marginal tax rate, not at the capital gains rate. So tax disadvantageous. There is an interesting fee and expense twist. Equity annuities do not have explicit annual fees or expense ratios. It makes money by giving investors far less than what they've earned. The insurance company takes a dividend plus 50% of the capital appreciation. I mean, it's just not a good deal for the customer. So their final conclusion is pretty negative. Equity annuities are complicated investments sold to unsophisticated investors without the regulatory safeguards that usually get with investments. Why? Because the SEC has so far said these are not investments. We're going to talk about life insurance products that are investments, are regulated by the SEC, but these products are not. So their standards are much lower. No registered rep, insurance broker, or retail investor, or precious few PhDs in finance could understand these products. The net result is equity annuities, complex formulas, and hidden costs, is that they survive as the most confiscatory investment sold to retail investors. Not the worst life insurance product, not the worst annuity, it's the worst investment product out there. I probably could find something worse. I think Tim Duncan could find you something worse when he got ripped off by his investment advisor, but at least his investment advisor didn't put him into an equity-linked annuity. But pretty horrible product. Are there some good ones out there? That's the debate I had with USAA. USA's life actuaries wanted to sell these products. Why? Because it was the biggest thing being sold at the time. USA could not sell this. What does USA not have that makes them not able to sell this? Have you gotten my mantra yet? What is USA missing that keeps them from selling these? Commission agents. Yeah, they do everything on the phone. USA has tried these other products. They tried the variable U-Life, they tried the variable annuities, they tried some other products, and they couldn't sell them. If you don't have a commission agent, they're pushing it because they're too complicated. Over the phone, people are like, yeah, no, I don't want that. That's no good. But they keep trying. If USA sells one of these, you might buy it just because I'll tell you what, the last 2 times they tried this, it was just a fiasco. They called the customers and said, we're shutting the product down, and they essentially bailed the customer out and paid them. The customer came out really well because USA wanted to shut the product down. So that may be the reason to buy it. But it's just not. So are there good ones out there? Good one is a relative term. There are probably some equity-linked annuities that are better than all the others, but still you're better off probably just keeping it simple and not having all these bells and whistles. I'm going to show you how to build one of these. I actually like this product if you build it yourself. I actually think your grandparents should be doing this, but not through the insurance wrapper. It's just too expensive. They charge way too much. All right, anybody? Well, all right, so Thanksgiving, you're going to get a big debate about healthcare. And when your uncle's screaming at you about healthcare reform and you're, rationally giving all your arguments, you can then ask him if he owns an equity-linked annuity, because he probably does. And then you can have another big battle. So I can completely ruin your Thanksgiving, but you probably have some of this in your family. These are really popular products. Well, the problem you're going to have if you have your uncle's probably really, really smart, but if he's not a finance person, the problem asking him about this is most people own these products don't know that they own them. They don't know what they're called. They have fancy names. And the person that brought me his product, it was actually an equity-linked life insurance product, and he didn't need life insurance. It was a horrible product. I had to read through the fine print to see that it was one of these products, and he had no idea it was one of those products. The way he was describing it, I was going, yeah, that doesn't exist. You have to show me what you actually purchased. He was real excited about it, and then they got out of it. So, all right. If any of y'all want to defend this product, you can go for it. Remember on the exam, for the exam question for ethics, you need to give my argument. If you disagree with it, if you want to spend time making your side of argument, that's fine, but make sure you at least acknowledge my side of the argument. All right, let's finish up the economics of insurance. We talked about your need for life insurance, your need for annuities, living too long. Another product the life insurance industry helps with is disability. Disability and health insurance are products that started on the property casualty side and have moved to the life insurance side, but there's still some health and some disability on the property casualty side. So for the life insurance side, you buy disability insurance for you as an individual. On the property casualty side, it's called workman's comp. You may have heard of workman's comp. That's on the property casualty side. It's also disability and health insurance, but on the life insurance side, it's disability. And it's similar to premature death, except you're still alive. So you're losing your human capital because you can't work because you've been injured, but you still have to feed yourself. You still got to take care of yourself. So you still have, it's a temporary situation, but you still have expenses. Unlike death insurance, life insurance, it's a one-time thing, and your family has to make up for your lost income, but they don't have to keep paying your expenses. And even if you don't have dependents, you need disability insurance. And it's actually more likely you're going to be disabled than you are premature death, especially in 30s and 40s. and depending on how dangerous your job is. Most of you won't need it because your employer provided to you. USA's disability was really, really good. I didn't need any. So most of you, if you have a large employer, you'll need it. Just be real careful. I worked with this a group. One of the guys had quit his job and started his own firm. He had a lot of disability insurance at his job, but he started a construction firm and he didn't buy any disability. He fell and hit his head, and it just devastated his family just financially. We raised a lot of money for him, but it was such a horrible, horrible situation. And he just didn't think about it, that I had disability here and I started a new firm. So if some of you actuaries or finance people, you go off and start your own firm, this is when you need to stop and think about disability insurance. What happens if you get injured and you can't keep doing your job? So it's extremely important. We'll talk a lot more about it. This is one of the most difficult products to sell because what we'll talk about a little bit later, adverse selection. There's people who like the fake injuries because they'd rather be at home watching TV than they would to be on the job or streaming, whatever they're doing today. So it's a tough business because you get a lot of fraudulent claims. So those are the products we'll look at. In addition to health insurance, I don't have health here because we're going to spend a lot of time on that. Another economic issue for insurance is, how is insurance different than gambling? They're both zero-sum games. You have a winner, you have a loser. So if you knew you weren't going to have any auto accidents the rest of your life, I mean, you have to have Part A legally, but you might be able to get away with not buying that or just buying the bare minimum. But you could get rid of Parts B, C, and D, especially Part D, the physical damage. So you're either going to pay more to the insurance company or they're going to pay more to you. Same thing with gambling. Both don't make sense when you're looking at normal rational economics like net present value. If you did a net present value on buying auto insurance, it would be a negative number. You're going to get back about 70% what you pay the insurance company. It doesn't make sense. So you can't use normal financial analysis. Gambling definitely doesn't make sense because you're expected to lose. It makes sense for the house, but it doesn't make sense for the gambler. But there is an important difference between insurance and gambling. Gambling, you're creating a risk that didn't exist before. You're risking your money and you're initiating it. Insurance is addressing an existing risk you have, and we're loss averse. So essentially what we say, I'd rather pay $1,000 a year for the next 20 years than be exposed to losing $20,000 all in 1 year. So we'd rather spread, even though we might spend $1,200 a year for 20 years to avoid losing $20,000 in 1 year, we'd rather pay that extra $200. We just like to do that because the downside is so bad. If you can handle it financially, then you can go uninsured. That's why people with that dependence, they don't need to worry about it. But we do on insurance because we're loss averse. We tend to hate large losses. We're willing to pay more than the expected return to reduce this risk. I was reading an economist article on China. People in China have a much higher savings rate than the United States. Much, much, much higher. But a lot of that is because they don't have the insurance infrastructure we have. If they get sick, they don't have the health care we have. So they have to spend out of savings. If their car gets damaged, so they essentially have to save more for those emergencies. If they had a better insurance market, they wouldn't have to save as much because they let the insurance market protect them. So there is a societal benefit. So insurance benefits society because you don't have to set aside so much money for those rainy days. You can spend, if people in China weren't saving 25% of their incomes, they'd be spending more and the Chinese economy would be much stronger. So it does provide that benefit to you. And allows you to do more productive things with your money. You're not just, how much, if you didn't have health insurance, you have auto insurance. I mean, you would be you'd have to set aside your emergency fund, typically say 3 to 6 months. Emergency fund would have to be $20,000, $30,000, $40,000. And who knows on the healthcare side, that could be $100,000, $200,000 bucks. So You have to be extremely conservative with your money without insurance. Insurance allows you to spend more freely, even though you're having to pay more for the risk than you expect to get back. But it gets back to what I said before. It is a losing proposition. So you don't want to buy insurance you shouldn't buy. Those things that are high frequency, are low frequency, low severity, those things that you can handle yourself, it's better off to handle them yourself. But those big items, those things that could really wipe you out, that's what you want to use insurance for. All right. What kind of risk will an insurance company cover? What are the actuaries? This comes down to the actuaries. What are the actuaries able to handle? So the first thing they need is data. They need a large number of homogeneous exposure units, because the actuaries need statistics to price these products. Now, in life insurance, what do you think our units are in life insurance? How do they break groups up for life insurance? We're going to have a mortality table. What do you think is on the mortality table? There's three real common ones: age, gender. What's the third one? Most common one. Do you blank or not blank? Smoke. So age, gender, smoking. So life insurance, they have gender tables and age, and then they have smoker, non-smoker. They also have ultimate and select tables, which depends on how long ago was it that you last saw a doctor. But those are the groups they do, and the actuaries know a 50-year-old non-smoking woman who just saw the doctor last week, this is her probability of dying in the next year. There may be other things, family history, other things they may have some information on, but they have tremendous amounts of information, very reliable. They price their products with tremendous confidence. The second thing that doesn't really affect life insurance is when a loss happens, it needs to be definite and measurable. You got to know the loss happened, and you have to know how much to pay for it. For auto insurance, you've got to call the insurance company and say you had an accident, and then they have to somehow get an estimate on how much it's going to cost to fix your car. Health insurance the same way. You got to make sure you tell them you had a health claim, and then they have to know how much that costs. Life insurance is a little bit easier. How do you prove you have a claim in life insurance? Why do you have to give the life insurance company? Death certificate. And that can take some time. I know some people that have death in their family and they really need the money. It's like, it may take a few weeks. You got to get them the death certificate, and the death certificate itself can take a few weeks. And life insurance from Measurable is really, really simple, because we tell them what the amount is. We tell them we want $100,000 of life insurance. There is no measurement there. Life insurance doesn't say, hey, when you die, we're going to pay you your human capital. So let's say you died at 46 and you're an actuary and you're really good at your job. You could be promoted. Yeah, they're not going to do that. That end up in courts. I've been asked to go to court to give a testimony on human capital, and I say, you need to hire an actuary. I'm not qualified to do that. I can talk about human capital, but I'm not someone to test. So there are cases when people sue, for wrongful death, they'll actually go to court and they'll figure out how much that human life was worth. Life insurance, we don't do that. You just tell them how much your human capital is, and that's what they put on the policy. The next thing is it has to be, I like to say it has to be accidental, but it has to be fortuitous or accidental. Essentially what they say is it can't be intentional. Now, this one, for life insurance, as horrible as they talk about suicide, with life insurance, there's actually a clause that says if someone intentionally takes their own life, life insurance will still pay as long as it's after a certain period of time. So if someone buys a policy and immediately takes their own life, it won't pay. But if they wait 3 years, have you ever read the book Death of a Salesman? Tennessee Williams. Do I read great books anymore? Or is that like everything's? So I saw it on Broadway. It was really, really cool. Some famous actor, I can't remember his name. Chris something. There was a famous actor in the role. But the poor salesman in there, he's a failure. His whole life is a failure. So he buys life insurance. He's going to finally do something good for his family, buys life insurance, takes his own life. And what happens? He doesn't get any money because of the suicide club. I mean, so even at the very, so it's a really depressing play. But if he had waited 3 years, it would have worked. So life insurance does pay for some intentional events after a certain period. What insurance pays for intentional? So auto insurance won't do that. If you wreck your own car, if you burn your own house down, that won't cover you. If you injure yourself so you can't work, disability won't cover it. But there is an insurance product that will pay you for intentional things. Do y'all know what that is? We're going to cover it later in this class. When's the last time you're walking down the street and you tripped and you accidentally fell into a doctor examination? So, oh man, I had a checkup. I didn't mean to. I was just tripped. I tripped, and here I have my check. I got it. Aren't most of your doctor checkups intentional? Pregnancies, aren't most of those intentional? Or a lot of them are intentional. Does health insurance cover doctor exams, even though they're intentional? Do they cover pregnancies when they're intentional? So we can see health insurance is a huge, huge issue here. How can insurance cover something when people are intentionally doing it? All right, we'll talk about it. President Obama talked a lot about this. There's one place where I disagree with him, but we'll talk about it. I kind of have to come back to his side more. I'll show you just because of the statistics than the philosophy. But we'll talk about that because he was a big advocate that health insurance should cover intentional acts like doctor exams. And is that true or not? And the last one is, it's got to be something that won't cause the insurance industry to go insolvent. We talked about this a lot more in my property and casualty course with things like hurricanes and earthquakes and floods. It's not as big of an issue on the life insurance side. COVID can be a little bit of an issue. Are people talking about the next plague that could really, really, really be pretty devastating? But I think I told you at USAA, they ran the Spanish flu through their books, and it just wasn't that big of a number, not compared to the hurricane risk on the property and casualty side. So this is more of a property and casualty issue. After 9/11, especially, terrorism risk was a big issue there. War is always a big issue. But for life insurance, most life insurance excludes war as a covered event. USA is one of the rare companies that does cover soldiers. But generally war for life insurance is a bit of concern. But that's usually not a big issue. For life insurance does really, really well on these three issues, probably better than any other insurance. Health insurance, disability really struggle on these because they're much more difficult products to know if someone's actually been injured. And actuaries, that's what they do. They're looking for data. We're going to talk about AI. Do you think AI is influencing insurance pricing today? The answer is absolutely. AI is having a huge, huge impact on insurance pricing. More probably on the auto insurance side with the, any of y'all have the telematics. They're watching you drive as you drive. But yeah, insurance is going to more and more be influenced by AI, and actuaries are probably becoming the leading users of AI out there in any industry. So they'll definitely learn. All right, let's talk a little bit about the industry. There's private insurance, social insurance, and then PBGCs. We're going to talk about the private market primarily. We will talk about some social programs like Medicare, Medicaid, Social Security, but not much. We're mainly on the private side. Sometimes the private side can be compulsory by the government, really just auto insurance. You have to have auto and liability. Usually, well, with the exception of healthcare, you could debate if health insurance is mandated by the government. I think the Affordable Care Act is somewhat pulled back on that. So most life insurance products are not mandated. The social insurance side, the government doesn't provide a lot of life insurance, or there is some life insurance component to Social Security, but mainly it's an annuity through Social Security, or it's health care. Healthcare through Medicare, Medicaid, and Veterans Administration. Medicare, Medicaid, and VA is not the majority of Americans, but it does cover the majority of expenses for health care. Why? Well, because it covers Medicare, which is elderly, and they spend a lot on healthcare. So they may only be 20, 30% of the actual insureds, but they're 70% of the actual payments. And we'll see that. Medicare, I hear people saying we need a single payer system like Canada and UK. We have a single payer system. Medicare, Medicaid, and VA is a huge portion of our system. Most of you will have private insurance through your employer, but on the payout side, it's heavily social insurance. And then PBGCs doesn't really get in there, but there is a little bit of that where the government does insure certain industries, like the FDIC insures banks. So we won't get into those too much. On the private side, it's broken up between life insurance and property and casualty. Accident and health is now under life insurance. It used to be on the property and casualty. In fact, there are some property and casualty companies that still have some health insurance. Not much, but some. The life insurance handles premature death and living too long. Accident and health covers health insurance and disability. And then property and casualty just covers all kinds of stuff, including those my last semester know my least favorite of all, title insurance. It covers all of these. And then you have the reinsurance market that insures the insurance industry. So it's true on the life insurance side, but it's a much, much bigger deal on the property casualty side. In fact, on the life side, it's usually life insurance companies insuring each other. Whereas on the property casualty side, you have these big reinsurers like Swiss Re, Munich Re, Gen Re that insure the insurance. Who owns Gen Re? What famous person in finance owns Gen Re? He just retired, announced his retirement. Warren Buffett, right? Berkshire Hathaway. So Berkshire Hathaway, y'all have heard Berkshire Hathaway's in the insurance market, right? Just type, and Peyton knows this. Who else? I can't remember who else was in my class last semester. But float and insurance, just type float insurance Warren Buffett, and about 1,000 sites will come up. That's his big thing. And so he owns Geico, right? If you have Geico, that's Warren Buffett. He owns Gen Re. So reinsurance is a big deal on the property casualty side. So you actuaries, you have to decide where you're going to work. I tell the actuaries, if I were going anywhere, I'd want to be at Swiss Re. That's like the greatest company I've ever seen. I love that company. If one of y'all work for Swiss Re, let me know. I don't think you have to work in Switzerland, but that wouldn't be so horrible. So great company, but there are some really, really good companies throughout here. But most actuaries are trying to decide life side or property and casualty side. Where are most of the jobs for actuaries? Property casualty side, right? A lot more jobs on the P&C side. So a lot of them, the alums that we had two speak to my class last semester. They were on the property and casualty side. I don't think I've ever had an alum from UTSA on the life insurance side. So I can't give you any of those guys. I just sent a Facebook message to one of them, a life insurance actuary yesterday. He radically changed my career. So I was just thanking him for helping me out 50 years ago. All right. What do insurance companies do? They do production. That's that marketing and sales that I dislike so much if the commissions are involved. They do underwriting. I've tried to get a life underwriter come talk to us, but last time I talked to him, he was just too busy. But underwriters, what they do is the actuaries are said how they're going to price the products. So the actuaries say, hey, people with these risks get this price. The underwriters have to figure out which bucket you go into. So the actuaries say, here's the 10 buckets. The underwriters say, you go in this bucket, you go in this bucket. So they select and classify those exposures. Good risk, standard risk, preferred risk, substandard risk are uninsurable. They try to pigeonhole applicants into those categories. Usually they do it through applications that you fill out. But on the life insurance side, more and more and more, they're doing blood tests and exams and those kind of things. Blood tests are getting faster now that you can do them pretty quickly. And a lot of that started during the AIDS crisis in the early 80s. I remember our life insurance company started doing blood tests, and they discovered it didn't really help them that much with the AIDS crisis, but it helped them to identify people that were abusing drugs, abusing alcohol. So they kept it. They said, man, this is really good information. So on the life insurance side, they spend a lot of money up front checking, whereas on the property casualty side, it's more applications. They look at your driving history, your driving record. Anybody from the P&C class, Peyton, you may be the only one. What was the other thing they look at that people don't like? Credit scores, right? Is that fair to use your credit score? If you have bad credit scores, you have to pay more for auto insurance. Does that seem fair? So we talked about that in my property casualty side. They don't use credit scores on the life insurance side. People with bad credit scores don't necessarily die faster than people with good credit scores. But on the auto side, people with bad credit scores do drive worse. They're trying to protect from anti-adverse selection. We'll talk about that a little bit. So the process, you have an application. Now, this class gets me phone calls. I go out on USA site, and I was doing it this weekend just to test it. I want to look at their annuity pricing and their life insurance pricing. And guess what? Today I got a call say, oh, Mr. Sweet, we saw you're on the site looking at annuities. Can I transfer you to a salesperson? I was like, no, I'm doing this for my life insurance class. So online, there is an application. So I was going in there, I was looking at the annuities for your, third article for paper one. I just want to compare what annuity could I get versus one my mom could get. That's where it was $4,000 a month versus $12,000 a month. So there's an application online. For the annuity, that's probably all I would need. That's all about all they care is my age and my gender. For life insurance, there probably would be extra steps. They might let me buy $100,000 just with an application, but if I wanted more than that, I'd probably have to have a blood test. They may go to agents and brokers. So if you may have someone show up at your door, they may do investigations if it's more expensive insurance. A lot of them use information bureaus like credit ratings. Let's see, what's Equifax? Have you ever heard of Equifax? We probably, when I was at USA, we spent quite a bit of money on Equifax. Physical exams. So you're the safest right when you go through that process, because that's when they have most information on you. So your insurance is cheaper, but 3 years later, 4 years later, it might be much more expensive. So you might want to go back and reapply and get a new policy just because you get a cheaper rate. We'll talk about that when we talk about level term insurance. So underwriting, if you are an actuary or finance person and you want to work in this industry and you can't get into finance, you can't get an actual, underwriting is the perfect place to go, because you get to learn the industry, especially actuaries are essentially doing kind of simplified actuarial science on the underwriting side. Finance people get to learn the industry from the inside, and you get to move over and do finance. So it's a great place to start. And they hire a lot of people, especially on the property casualty side. Loss adjustment, these are the people who pay claims. On the life side, it's a department of 2 or 3 people. On the property casualty side, it's like at USA is just thousands of people. It's massive. A good friend of mine, he was loss adjustment in the life side for USAA life insurance company. He had the most interesting stories. I wouldn't tell them to you because they're kind of morbid stories, but one thing I'll tell you, if your a significant other buys life insurance on you and then wants double indemnity, y'all know what that is? How do you get, so you buy a $100,000 policy, but they'll pay you $200,000 if what? There's a famous movie called Double Indemnity. They'll double it if you do what? The person did what? Died in an accident. They died in an accident, get twice as much. If your significant other wants a double indemnity, you're likely to have a horrible, terrible death. Because not only do they have to kill you, but they got to make it look like a freak accident. So one of the most famous stories you may have heard of, when the Tylenol capsules were being laced and people were dying from that, this woman had this great idea to give cyanide poisoning to her husband so that they would think he died of the laced tablets, and then she would get double indemnity. The problem is they thought he died of natural causes. And so she didn't get the double indemnity. She said, well, okay, well, this is a pretty horrible person. So she laced some tablets, put them on the shelf in the grocery store, killed a woman, and then called the police and said, hey, I got my tablets from that same place. Is it possible my husband died of that? How did they catch her? They found some of her fish food in the tablets. She accidentally mixed some of her fish, and so she went to jail for the rest of her life. But that's what people do on the double indemnity. That's the loss. So if you want to work in this department, you'll come home with some really cool stories. I might show you one of them. USA got sued by someone named True. If I can find the video, the True case, their last name is True. It has nothing to do with false or true. It's a bizarre story of this guy who said his wife said he was kidnapped and tortured and killed. And the people looking at it said, no, he set this all up and killed himself. And that was the big battle. And the story is freakier than that. I can't tell you the details because it's grotesque, but if I can find a YouTube video, you can watch it. So yeah, on the life side, you get some pretty crazy stories. On the P&C side, you get some crazy stories as well. I'll probably tell some of you these again afterwards, but people lie a lot. They make stuff up. The one story I'll probably tell you again because I can never remember what I tell you, but the adjuster goes to the guy's house because he had been robbed and the guy wasn't home, but he had the guy's mom's address. So he goes to the mom's house. Hey, don't know where your son is? He says, yeah, he's not home, but all this stuff is in my backyard. And the guy goes, oh, all the stuff you had stolen is in your backyard. Okay. What happens to you if you file a false report? How serious of a crime is that? Will you go to jail? Absolutely, you will go to jail. It's a pretty serious crime. So don't do it. I don't encourage it. But loss adjustments on the life side, it's not quite because it's very low volume, fortunately. Property casualty side, if you're a finance actuary, that would be a great place to work too, as far as learning the industry. It is a very difficult job, though. Very, very difficult job, very stressful. At USAA, the loss adjusters, this is before USAA paid time off. When they had sick time off and vacation time, the loss adjusters took 100% of their sick leave. And no one complained. He said, let them have it. It's a really, really tough job. So, but you learn a lot. You probably learn more doing this than any other job as far as how the business actually works. But people are calling you at a really horrible time and they're pretty upset and they think you're gonna rip them off. But the adjustment process, they notify you that you had a loss, you got to investigate it. You need some kind of proof of loss, and then you either pay them or deny them. Now, I've had from my property and casualty course next semester, I have some videos. There's been some testimony by State Farm and Allstate. I don't know if y'all seen these before Congress, or they're just getting ripped left and right on some pretty questionable claim denial. We looked at some of that last semester on Hurricane Katrina. It's tough. Insurance covers hurricanes and winds, but doesn't cover flood. But if a hurricane comes through and all you have is a slab, what caused the damage, the hurricane or the flood? What does the insurance company say? It was the flood because we don't cover flood. So, it can be rough. The life side, you need the death certificate. You might investigate to make sure there's no foul play, like the person was killed, or if the person took their own life, those kind of things. But it generally is not that much of a process. Property and casualty side, much bigger process. Now we talked about disability insurance and health insurance. There, the process is much more involved, much more work, much more expensive process. What about Medicare? We'll talk about it. Medicare pays so many claims, like over 1 billion. I mean, if you actually did the math, if Medicare workers spent more than 5 minutes per claim, you couldn't hire enough people. So obviously the computer and AI is doing most of the work and you're just paying them. So there's a lot of fraud in Medicare because the volumes are just so massive. Actuary, a lot of y'all want to be actuaries. Great job, great career. Um, they do quite a bit of stuff. They price products. They set up reserves. Last semester, y'all saw the catastrophe and reinsurance guy. Kirby spoke to us. There's a lot of jobs on the actuarial side, very, very interesting. On the life insurance side, they price products, they set up reserves. They also do asset liability management because insurance companies on the life insurance side have a lot of interest rate risk. So the actuaries get involved in that as well. She took my risk management class. We talk a lot about that. P&C side has more jobs. The problem, we talk about optionality. The property casualty side doesn't have as much optionality as the life insurance side. And the reason is the life insurance side gets heavily involved in the investment side with interest rates and investments. So the guy who took my place at USAA, I was head of equities. We need an investment person to take my place. They hired a life actuary to take my place. Obviously, I wanted to hire him because I love actuaries. So I said, yeah, hire this guy. Very, very good at math. He still teaches here. John Tui, any of y'all had him? So he's an actuary. Y'all know he's an actuary? Yeah, you should. That's the reason he's teaching the fixed income class because he had that experience on the life side. So life actuaries can easily shift over to the property and casualty side. The benefit side, I would be a little leery of right now because we just talked about that. Defined benefit plans are going away. Who knows what's going to happen with healthcare reform? Benefit side tends to be heavy, heavy, heavy on the tax code. I remember at USAA, my good friend Michael, he was the actuary at USAA. He would meet with all the execs to talk about their benefits. It was all tax code stuff. He would talk for an hour and say, anybody have any questions? Everybody just sat there, and after the meeting, everybody went up and go, Michael, what do I do? Because no one had a clue what he was saying. It was so complicated. So if you want to learn the tax code, go on the benefit side, but I don't know. That's very stable. You can work for the government. The government does hire actuaries. I'm sure Medicare and Social Security has actuaries. The ALM function, asset liability management function, mainly on the life insurance side. Those can be really good jobs. And actuaries sometimes just forego actuary altogether and just, there's so many AI and machine learning jobs today, they can go anywhere they want. So, I mean, a lot of options there, but the actuary side, if you work there 3 or 4 or 5 years, you probably could jump to another career pretty quickly. Who knows what AI is going to do in the next 5, 10 years. I would say to all of you, finance or actuarial science or whatever you're doing, I always tell students your first boss is the single most important part of your entire career. It's not your first company. It's not your first industry. It's your first boss. And right now, your first boss better scare the life out of you. I have too many students that are training their first boss after 3 months because their first boss can't do basic Excel. What do you need to be doing in your first job? You better be doing coding if you're a finance major or an actuary. Actuaries will, right? You can't avoid it, but finance, you better be learning Excel. You better be learning AI, machine learning. So what do you want? You want a boss that every time he or she opens their mouth, you're like, I don't have a clue what they're talking about. You need to be working there. You got to be scared to death. So your first job, if your boss doesn't freak you out, you're in the wrong. You can't waste your time on easy jobs in this market. So some students say, I want to learn Python. That's great. But if you learn Python, but you're not doing it on the job, you're going to forget it. You need a job where you're using it every single day. You're using SQL or whatever you're using, Java. I don't know what y'all all use on the actuarial side. Just use it every day. So it becomes second nature. How did I learn Excel? I was sitting there doing it 10 hours a day, right? All week long. Did I get good at Excel? Yeah. And my job used to be so easy in finance. How did you do well in finance? You learned Excel. That's no longer the case. You got to learn Excel, and that's just basic, but you also have to learn all these other things. So the way you do that is your first job. Pick your first job based on what scares you the most, based on Python coding, AI, those type of things. You just got to do it. And I promise you, I have students that are indispensable 3 months into their first job. If you're indispensable 3 months in your first job, you're working for a really horrible company. There's no reason any college graduate should be indispensable. used to be useless your first 3 months. I've had some jobs where I'm just like, man, I'm too stupid to be here. You're in the right job if you're thinking that, right? Because you're all smart people. You're going to learn it, but you want that learning curve as steep as possible. So yeah, so actuaries, someone have that. Every actuarial job is going to scare them to death. It's going to be a tough job, and that's good because they're going to learn a lot. Then you get to the investment side. I got to that second part of my career on the investment side, but I did work a lot with the investment side earlier than that. The insurance industry is a great place to be an investment portfolio manager. They have very specific goals and objectives. So it's portfolios where you know exactly what you're trying to accomplish. So I love that part of my job. I worked a lot with the life side, the P&C side, the bank. So all different sides, different type of models, the pension plan. It is a fun business. There are some life insurance sides where you could spend your whole career doing that. It's probably going to be more fixed income than equities. I remember meeting the investment team from New York Life, just thinking, man, I'd love to work here. Kind of like my same reaction to Swiss Re. It's like, man, this is the place to be at. I just love departments where everybody's curious. They're all collegial. They're working hard. They're always asking questions. And that was New York Life's investment side. So the life side is, they've got a lot of cash, billions and billions and billions of dollars. And it can be a really, really great place to work. It pays extremely well. That's why some actuaries shift over to this side. Actuarial science pays well, but this part of finance can pay much, much better. So if you're an actuary, especially if you're on the life insurance side, you might think about getting a CFA exam and jumping, and you might see your salary go from 200,000 to 700,000 in 1 year, which is kind of nice, right? To triple your salary in 1 year. I had one actuary from this class. He's working for Carlyle Group. So I go, Joey, how's your actuarial career going? Oh, that's great. I'm not doing that. I'm doing investments for Carlyle, and he's making a fortune. It's really high paid. So, all right. Any questions on careers? There's obviously all the other careers like accounting, marketing, all those other things, but they're very similar to other sides. The life insurance side does have a particularly large tax department because life insurance taxation is pretty complex. So if you're an accountant, you want to do tax, you could do that. The industry itself is a little unique in that it has these things called mutuals. So mutual insurance companies, they're owned by their customers. They don't have stockholders. And there's some pretty famous mutuals out there. So Northwestern Mutual, you'll see them on campus. They tend to recruit here quite a bit. That's a mutual insurance company. State Farm is a mutual insurance company. Prudential used to be a mutual, but now it's a stock company. There's also reciprocals, really only on the property and casualty side. There's only 2 reciprocals I can think of. Anybody know those 2 ones here in town? Any guesses? How many insurance companies do you know in town? USA is a reciprocal, and what's the other ones? They have a really great jingle. So Farmers, y'all could all sing their jingle, couldn't you? So Farmers, I'd almost sing it now, but my voice is terrible. So those are the only 2 reciprocals I know. Farmers is actually owned by Zurich. And when I went, I was a UT Austin grad, and I was in the Longhorn band. So I went back to one of their alumni bands, and one of the trumpet players in the band works for Farmers. And I was like, how are y'all reciprocal if you're owned by Zurich? He says, I'll tell you, I'll explain it to you, but I never got a chance to ask him. So that one's a little unusual. USA is not owned by anybody else. It's a reciprocal. It's really hard to explain the difference between a reciprocal and a mutual. The reciprocal, the CEO of reciprocal has like this special fiduciary relationship with the owners, but it is owned by its customers. Probably the biggest difference in reciprocals is the tax law. Reciprocals get incredibly favorable tax treatment. In fact, USA is the only company I know that when they buy stocks, public stocks like Apple or whatever, their after tax return is higher than their before tax return. It's the only entity I know. I remember when I did this, I did a study on USA and said, okay, before tax, we make 8% on stocks. After tax, we make about 8.7% on stocks. If you're like, what? How do you do that? So if you ever want to know how to do that, I'll explain it to you. But it's a very, very unusual entity. They do have huge tax advantages that other entities don't have, similar to credit unions. So who owns a credit union? Well, its customers do. But credit unions are tax-free. They don't pay tax. USA is not tax-free, but they have one massive tax deduction that can essentially make them tax-free. And they get that at the reciprocal level. So it's interesting how they can actually prop up their taxes doing that. They could really, really exaggerate this and make bundles of money from a tax standpoint. They don't exaggerate it because they don't want the IRS to shut it down, but they do have a huge, huge advantage. Then you have stock companies. These are companies that have, you can buy their stock. They're publicly traded, like Prudential, like Allstate, like well, Berkshire Hathaway. That you can't invest in Geico, but you can invest in Berkshire Hathaway that owns Geico. If you look at insurance companies, so Met might be the largest. I'm not exactly sure, but I'll put MetLife in there. We'll look at MetLife later. So MetLife has about $700 billion in assets. How much assets does JP Morgan have? It's not 700 billion. Anybody guess? How about 4 trillion? So I don't know if Met's the largest life insurer, but it's pretty close. I can look at Prudential. 700 billion. I think that's about as large as you can get on the asset side, on the life insurance side. On the property and casualty side, much smaller, 200 billion. Can y'all think of another major Progressive? I can't remember their PGR. Much, much, much smaller. I can't think of a really, really large insurer besides MetLife and Prudential. Allstate, I don't think it's all that large. 100 billion. I don't know. Do y'all know this history of Allstate? Who owned Allstate before they spun them off? Any guesses? It's the same company that owned Discover Card. Y'all are too young to know this. So have y'all heard of Sears and Roebuck Company? Have y'all heard of Sears? Y'all probably never been in a Sears, but have y'all heard of them? Sears out of business now. I looked at their last market cap and I could actually purchase Sears myself. But Sears spun off Allstate. Sears spun off the Discover Card, and then Sears and Kmart combined. Remember, Kmart was the largest retailer in the world. Then Sears was the largest retailer in the world. Sears bought Kmart, and two of them together are now worth like $1 million or something. So, but as bad as Sears is doing right now, there's some residual. So Allstate and Discover Card. I don't know how big Discover Card is now, but some big companies out there. But not like the banks. So banks are $1 trillion. Insurance companies are a few $100 billion. They're just not as large. I can't show you some of the others because they're mutuals. So it's possible Northwestern Mutual is larger. I doubt it. Possible New York Life is larger. I think it is. We'll see. I don't know if that's the same one. Equitable has been all over the place. So I'm not so sure what their other holdings are. Yeah, it's just not as large. Banking is just massive. Now, banking wasn't that large when I was there. So banks have consolidated for a minute. Remember, we talked about life insurers, they should have consolidated. Banks did. So it was rare to have $100 billion banks when I was doing banking. But now you're seeing multi-trillion dollar banks today. So they're not as large as the bank side, but they're decent sized companies. So there are stock companies out there, they're mutuals. State Farm is the largest mutual on the property and casualty side, but it's mutual. I mean, it's the largest insurer on the property and casualty side, but it's a mutual, so I can't tell you how large they are. There are government agencies, obviously, that do this as well. They have different type of pricing structures. We're going to talk about participating and non-participating policies. It's a fairly unique aspect of the life insurance side. And then the distribution system. They can have independent agents. These are people who sell insurance from multiple insurance companies. And this word agent is really, really important. We may talk about it later in the class. I was telling the P&C class last semester, I'm amazed y'all don't take business law classes because they're just so critically important. I mean, if you can take an elective, I would take business law. If you work on the insurance side, you need to read the chapter on agency law. It's really important on the insurance side. What is an agent? An agent is someone who's doing something for the company, but can they bind the company? That's the question. Are you an employee? Are you an agent? If you're an agent, can you bind the company? Independent agents usually can bind the company, which means they have the company's authority to enter into a contract with the insured. A broker doesn't. A broker is not an agent. So when they enter into a contract with the insured, they have to get approval from the insurance company before the policy is accepted. That's really important. Are you an agent or are you a broker? If you're an employee, so exclusive agents, so like State Farm, you're not allowed to sell insurance for anyone but State Farm. You're a State Farm agent. You're obviously an agent for State Farm, and employees are agents of the company. They can usually bind the company. And then you have like USAA and Geico. You have direct writers where they have a salary sales force and they usually sell by the phone or internet. USA was the largest direct writer for the longest time, especially on the auto insurance side. And you want to know on the auto side, State Farm has been 20-25% of the industry, USA about 5% of the industry. State Farm has come down because Geico and Progressive have been going up. So I don't know what State Farm is today, but Geico and Progressive have been moving up pretty quickly. On the life side, it's much more dispersed. There's a lot more companies, and it's hard to know who's really dominating that market. So this is pretty important because it impacts those incentives, why they're selling, what they get out of it. So I'm a big fan of direct writers. I like the incentive not to be a commission, but those are different types of companies. There's some websites that are useful out there. We may talk about some of these. The NEIC is the regulatory side. Their website has some interesting, you want to know what issues are going on in the industry. So if you're about to interview with an insurance company, you might go out to NAIC and just see what issues are coming up. AM Best rates insurance companies. It's a rating agency, but they also have a website with some really good industry stuff. So it's another good place to go right before an interview. The ACLI, the American Council of Life Insurers. That's a good place if you're interviewing with a life insurance company, what issues are going on, what's important right now. I don't know what's on their website right now. It tends to be a very actuarially focused group. News and analysis, all publications and research. So it's a good place to go and just kind of skim through and say, hey, what is this industry talking about right now? I know when I interviewed from USAA, they asked, what do you think is the most pressing issue right now? They asked as an accountant. I mean, accountants never have any pressing issues, but they asked on the insurance side, you'd want to be able to answer what's the big issue going on in insurance right now. It's getting pretty easy right now. You just say AI, right? Just AI. Or my Spanish classes, it's IA. But bring it up. It's big everywhere. So I would, if you don't know what to bring up, say AI, and you probably have to guess how AI is going to influence the industry. And then the SOA, anybody know what that stands for? You actuaries? Yeah, have you used their site at all? So good to know on the actuarial side what they're talking about and what's there. You also have Be an Actuary, which looks like Being Actuary. It's a good site. Focused on college students. So some good sites. So if you're interviewing for jobs, have a list of those major issues going on in the industry. Have some thought. They're very different on life versus the P&C side. You're gonna have plenty of issues when we talk health insurance, so don't worry about that. We'll have plenty of those covered. We'll hit a few of them. Be careful you don't bring up too many issues in this class, because if you go into an interview talking about how the insurance industry scams people, that may not go over well in the interview. But you can definitely say, I want to work for a very ethical firm that treats its customers well, with good products, with good incentives. You can say all of that without getting into trouble. So there's the industry. It's a great industry. We are going to have an industry day. I forget the date. I'll have to look it up. I'll let y'all know. It's going to be focused more on the property casualty side. I hope some of y'all applied for the scholarship. But that group is going to bring in, I'm begging them to bring in other companies besides just USAA, although USAA is great. I just spoke to someone at USAA last week, one of our former students. It's a great company, but I want you to see State Farm, Allstate, and all these other companies. So we're trying to bring some of them in. All right, we did ethics. Let me finish up with this. An ethical issue. This lottery winner, he won the jackpot. He won half of 336 million bucks. What could go wrong? He should have called me. He would have been in perfect shape, because I would have put him into a Vanguard fund that charges almost nothing. But unfortunately, whom did he run into? What do I keep saying over and over again? Okay, what kind of commission-based life insurance? Guess what they did? He bought a $100 million life insurance policy. Now he's suing them. They encouraged him to sue. This guy just won, what, 100, or I don't know what his net take home was, but he's encouraged to take on debt. Why would you take on debt if you just won the lottery? So this guy won the lottery, taking in about $70 million after tax. He began investing with two financial advisors who are also attorneys and insurance agents. Okay. That's like the trifecta of bad people, you know, is not all of them, but if you want to know the tail of the distribution, that tail has the worst tail of the distribution. That is three horrible groups of people on the worst side. He bought 4 policies from 4 companies. They told him he could earn $50 million by the time he turned 50. He says the agents made $1 million in commissions, exploiting the fact that he knew nothing about life insurance, had no need for life insurance. He had no chance to benefit from the insurance financially because he wasn't a beneficiary. 2 years later, the defendants attempt to persuade him to exchange his existing life policy for a single policy. Why? They get commissions. He learned that his existing policies were highly unsuitable for him and were funded in a way that would provide him no potential benefit. He claims he finally surrendered the policies after paying nearly $2 million in premiums, seeking damages. That's our industry. That's our sales agent. All right, we talked about the articles. Hopefully, I've already seen one of y'all is making good progress. So you got a lot of notes there on the first paper. Yeah, I gave you quite a few notes, so you might kind of skim through those. Wow, that's like half our notes, isn't it? All right, so where we're going next, on page 17 of notes, we're going to spend a few classes on life insurance, a few classes on annuity, and then a lot of classes on health insurance. So we'll start with life. There's 2 essay questions on the first exam. One of them you already have on ethics. The second one we're going to have on term versus perm. So we'll get into that. So next class, I'll let you out a little early. Next class, we'll be getting into the policies. All right, we'll stop it there. So tonight we got a few groups of products: life, annuity, health is really just one product, but disability. But life insurance has 2 big pieces, 2 types of products, and then subcategories on each one. Annuities have a few categories. We have an exam in about 3 weeks, so we got to make sure you cover everything for that. So let's get into the types of life insurance. If they were to sell something to you, this is actually quite valuable to know if an insurance agent approaches you, because They want to sell the permanent insurance because they make much larger commissions doing that. But the term is probably more valuable to you. So you hear them pushing one product over another. It does help to know the difference. So we're talking about life insurance. It doesn't insure you against death because everybody's going to die, but it's insurance against premature death. Typically, there can only be one claim, although there are a few rare examples where someone gets more than one claim in a lifetime just because they go missing for a while. It is not an indemnity product policy. So indemnity is your health insurance, your auto insurance. What indemnity policies say is we want to bring you back to where you were before the accident. So your car was damaged, we'll fix your car. Car was totaled, we buy another car about the same age. Health insurance, you broke your leg, we'll fix your leg. Life insurance is not indemnity. It's what we call a valued policy where you determine the amount that you're going to get. So it's up to you to decide. Your human capital might be $600,000, but you might buy $1 million policy. You might buy a $200,000 policy. What's the max you can buy? And whatever you want. If you want to buy $1 million policy from every single life insurance in the United States, you can do that, and there's no rules against it. They might investigate after you die to make sure there's no funny business going on, but there's nothing illegal. Other policies, you can buy multiple auto policies, multiple health insurance policies. Most of them are offsetting. So if you buy 3 health insurance policies, one of them's going to pay. Not all 3 are going to pay. With life insurance, they all pay. If you have 4 policies, they all pay you. So it's a little bit different type of insurance. They're worried about, any kind of foul play going on, but otherwise, if the person died naturally and there's nothing going on, you can buy as much as you want. So it's not like they're checking how much you buy versus your human capital. Now, if someone's making $20,000 a year and they buy a $20 million policy, yeah, they're going to investigate. There's something, especially if they die 2 days after they buy the policy. But they investigate. If they can't find anything, and the person bought it and they can't find anything that was going on, they got to pay the policy. That gets down to what insurance companies are worried about is making sure people are buying the policy for the right reasons. So one thing you need to have in place when you buy insurance, all kinds of insurance, is insurable interest. And what they mean by insurable interest is the person buying the policy would rather not get the insurance. So for life insurance, they'd rather live than their beneficiaries get the policy face. For auto insurance, they'd rather not have the accident rather than getting the proceeds from the accident. So the one buying the insurance prefers that the one whose life is insured, that they prefer them alive, even after considering the proceeds. You almost always have insurable interests on your own life. So if you're both the policyholder and the insured, yeah, they assume you have insurable interest in your own life. We already talked about there's no legal limit. If the insured and the policyholder are not the same person, they'll usually require, for most policies outside of life insurance, for most policies, you have to have insurable interest the entire time. So if you buy auto insurance, you can't buy auto insurance on your car and then sell your car to your neighbor's 16-year-old kid and keep the insurance on the car. All right. They cancel it. And if you don't tell them, they'll cancel it. They'll just give you your premiums back. Life insurance is different. You can buy life insurance and then lose the insurable interest. Like a married couple, they get divorced. They live on opposite coasts. They hate each other's guts. They can still have life insurance on each other's lives. So life insurance is really the one exception where even after you don't have insurable interest, you can still be insured. You just have insurable interest when the policy is purchased. Insurance companies want to get consent of the person whose life is insured. If you're buying a policy on your own life, that's not an issue. But if you're buying your policy on someone else's life, they want that person's signature. Had there been fake signatures? Well, I love the programs, Forensic Files and some of those. And life insurance is a big part of those, aren't they? Isn't that the first thing they ask for? Is there any insurance? So, the spouse died in unusual circumstances. Oh, and the other spouse bought a $500,000 policy 2 weeks before. That makes them wonder what's going on. Then I look at the signature and they say, wow, that signature looks like a photocopy of of their signature, not their actual signature. They'll do that kind of an investigation. So you need a signature. If it's forged, then that can cancel the entire policy. So insurable interest is important. Most people who are buying insurance own their own life. There are a few exceptions. My parents bought insurance on their kids' lives, so we got a policy, real small policies. Some parents do that, but generally, and with that, I didn't sign it because I was a minor. So in those cases, it's a little bit different. Anti-selection is very, very important for life insurance and health insurance. And what that means is the people who need the insurance are more likely to buy it than the people who don't. So unhealthy people are more likely to buy life insurance, more likely to buy health insurance. Healthy people are more likely to buy annuities. The insurance industry knows that, and so they actually charge you more simply because you bought the policy. The simple fact that you buy the policy puts you into a higher risk group. So if you buy a life insurance policy, they're going to charge you more because now you're a life insurance policy buyer. So you must be more likely to die than someone who doesn't. You buy an annuity, they're going to charge you more because you obviously think you're going to live longer. So life insurance mortality tables reflect the mortality of people who buy life insurance, not the mortality of everybody. What does that mean? That means if you're really healthy, you're overpaying for life insurance. Just by definition. If you're buying it and you're really, really healthy, you're paying an extra premium. How much extra is it? It may not be much with life insurance, but there is something there. Morale hazard with an E. That's very, very important. Not moral hazard. Morale hazard really doesn't apply to life insurance, I don't think. I doubt it applies to health insurance, but you can maybe say that it does, but it definitely applies to auto insurance. But so with anti-selection, people who are bad risk want to buy insurance. With morale hazard, you buy the insurance and that causes you to become more risky. It's really easy to talk about with auto insurance. I probably gave the same example last semester. You buy a Ferrari for your $150,000. You're picking it up, about to drive home, and you realize, oh, I forgot to buy auto insurance. So how do you drive home that night? Every time you see a car, what do? You drive off and park. You sleep in your garage, in the car with a shotgun, right? And the next day you buy your insurance. Do you drive any differently the next day after you have the insurance? Yeah, you become a riskier driver. Is that true with life insurance? You know, anyone says, you know what, I've got life insurance now. I think I'm going to go bungee jumping. Probably not, because you got a lot of skin in the game with life insurance. With auto insurance, yeah, you can drive a little more risky because someone steals your car or wrecks your car, you've got coverage and you still have your life. So I wouldn't think morale hazard really applies for life insurance. Now, moral hazard, if you take the E off, moral hazard is the buying the insurance causes you to do something illegal, like burn your own house down. That's illegal. You go to jail for that. That's moral hazard. But morale hazard is there's nothing illegal about it. It's just the way we are. Knowing we have the insurance means we can take more risk than if we didn't have the insurance. So types of insurance are only two life insurance types, term and perm. Although I'm going to talk about one policy that has traditionally been in perm that I think might actually belong in term. Term is very, very straightforward. The only thing you don't know at term is how long is the term. But once you know the term, you're covered for that term. If you die during the term, you're covered. If you die outside the term, you're not covered. Permanent usually means you're covered for your entire life, but we'll talk about universal life and even some of these others that may not be true. These have a cash value, which means this is insurance that has a savings element. So you're buying both insurance and an investment or a savings vehicle. That means with term, if you die with term, you get paid as long as you die during the term, but all you get is the face of the policy. With whole life or permanent, if you decide to cancel the policy, you get some of your money back. You get that savings element back. With term, you don't get anything. If you cancel term, you're done. A good term here is bundled. What bundled means, we are combining two things, life insurance and an investment product. So they're bundled together. And we'll talk about bundled versus unbundled on the permanent side. You can kind of tell which product is which by looking at the premium payments over time. Now be real careful. I put this in the notes. Your exam one has an essay question with graphs in it. It is not these graphs. All right. It always bothers me when a student, because I can't give you any points if you do these graphs. These graphs are not anywhere on the exam. All right. So don't get confused. So term insurance is this big blue line. What term? Annual term. So you buy term insurance every year. As you age, the premium goes up. Level term is you get term for about 10 years and you have one premium for 10 years. You get the kind of stair step. As you age, it goes up, but it's fixed for the term. So it's going to be more expensive than annual term for a few years and less expensive for a few years. It kind of breaks in between. If we look at this more closely, whole life, ordinary whole life, what ordinary whole life is, you're covered for your entire life and you pay the same premium for your entire life. That premium is just fixed all the way across, never changes. That's this gray bar here. So when you're young, whole life is much more expensive than term. Why? Because when you're young, you're much less likely to die. But as you age, get riskier. What whole life does is they charge you more early so they can charge you much less later. And this yellow line is the limit pay whole life. Limit pay whole life, you pay a fixed premium, but you stop paying the premium maybe when you turn 65. So you only pay for, so it's a little bit higher. It's hard to tell that's a little bit higher. It's a little bit higher. So level term is actually pretty good because what do you notice about level term? It gets real expensive when? Why are you buying insurance? What's the purpose? To provide money to whom? Your dependents. Do you have dependents when you're 60 years old? Today, I guess you do, but there's more kids living at home, right? Because the economy's gotten pretty tough. Housing is pretty expensive, but typically, even if you have kids living at home, they're going to pay something. So generally, you get to a point where the insurance gets too expensive if it's level term, but that's at a point in time where you may not have dependents anymore, so you don't need the insurance. So level term for a lot of people is all they need because during the years, and we'll talk about this, that during the years they have dependents, the insurance is going to be its cheapest. Okay. Annual renewable term is something you might do if you just need insurance for a few years. Maybe you're in between jobs or something. Your employer provides your insurance. Many of you will get free insurance when you get your first job at USAA. I think it was 2 times salary. So my salary times 2, I got it for free. USAA paid for it. That was more than the insurance I needed. So just getting that from USAA was more than I needed. I've never bought life insurance on my own life. Most of you, I would recommend start with level term as your first choice, especially if you're in your 20s. As you get older, whole life can make sense. Older ages, we'll see. But my parents bought insurance when they were in their 50s. They probably should have done whole life instead of what they did. I'll show you what they actually purchased. All right, so don't draw this graph on your exam at all. I did it in 2 pieces. One was over many, many years, but you can't really see the graphs, so I broke it out. How did I build these graphs? Exactly what we're going to do in the second half of the class. I used the mortality table, and so this isn't like hand-drawn, like to make it look, these are actual numbers off a mortality table. I priced the life insurance using an actual mortality table. Now, remember I said life insurance has huge tax advantages. The biggest advantage is the benefits are tax-free. So if you buy a $200,000 policy and your premiums are $50 and you pay 2 premiums for $150, $50, $100, and your beneficiaries get $200,000, that's all tax-free. That's a pretty good advantage, pretty massive. To the extent there are investment gains, so let's say you don't use the life insurance, instead you cancel the policy and you get the cash value back, then the cash value is taxed, but it's deferred. You don't pay tax until you surrender the policy. So you get tax deferral. Insurance companies figured this out, and so they started creating some products that really weren't life insurance, but they kind of look like life insurance. They were created entirely to get the tax benefit. And the IRS said no. So they said there's some contracts that are MECs, some are non-MECs. If it's a MEC policy, this doesn't apply. They're actually going to tax you on that. That doesn't mean they're bad policies. I'm actually a big fan of endowment contracts. We'll talk about them a little later. They are taxed, but they do get the deferred tax. You don't pay tax until the event happens. So you do get a lot of deferral, but you still pay tax, but it is somewhat favorable. Non-MAC means it's just like this. It's completely tax-free. This will make more sense when we talk about endowments and how they work. But just real quickly, what an endowment is you get the life insurance whether you live or die. So the endowment might last for 10 years. If you die in the 10 years, you get $500,000. But at the end of 10 years, you get $500,000. And what people are doing is say, wow, you get the money where you live or die. It's not really life insurance. And if everything's tax-free, it's like an investment. You can put your money into it. And whenever you get it out, it's tax-free. It was like too good to be true. And that's what the IRS said. Yeah, it's too good to be true. And so what insurance companies do is they structure the policy as much as they can to make it non-MEC, but they still do sell some MEC products, and they're still really good products. We'll talk about them. All right, so let's get into the policies. On the term side, we talked earlier how short term can be. If there is flight insurance, that's about as short as you can go. You fly from here to Dallas, you could buy term insurance for that. So however long the flight is, that's what it would cost. That's your period of coverage. Renewable term is that annual return that you get, and it's just going to increase generally with your age. Anybody know? We might have talked about this in my property and casualty class. Generally, as you age, your mortality goes up. There's two exceptions, though. Where on the mortality table is where you make it one more year, your mortality chance of dying actually goes down. There's two periods of time. When's the most dangerous time early in life? Yeah, right at birth. So your first couple years, pretty dangerous. I mean, it's not that dangerous now. It's much less dangerous now. If you want to, people talk about how we're living a lot longer. Part of that's skewed because childbirth was so much more dangerous in the 18th and 1900s. So a lot of our extended mortality is just that more people are making it past 3 years old, 4 years old. So your probability of living actually goes up in those first couple of years. What's the second point where people living one more year or have a lower mortality, and it only applies to men? What do men do that's really dangerous and suddenly not so dangerous? You were in my property casualty class, remember? What was that? Driving. What happened when you turn 25? For some reason, you become a better driver. And you can see that in mortality table. 24-year-old men die at a higher rate than 25-year-old men. It's not entirely driving. 24-year-old men do other stupid things, but driving is the most dangerous thing that they do. So yeah, it's not huge. It's not like it goes from 17% to 0.1%. It goes like from 0.2% to 0.18% or something. But those are the only 2 points. Generally, after 25, everybody's just going to see their probability of dying is going to go up year after year. We get older, we get a little less in shape. So renewable term, with renewable term, you're guaranteed the right to renew. And a lot of these policies, you get the guaranteed right to renew without having to prove insurability. So what they say is your rate goes up with age, but not with your health condition. So it's general. As people age, they're going to increase your rates. But if you get really, really, really sick, you're probably going to renew the policy because they're not going to reprice it for your sickness and your illness. They're going to reprice it based on people your age. So there is some benefits there. It will go up, but just generally. So generally what happens with the renewable term over time is that the healthy people are going to get out and the unhealthy people are going to stay in. So that's in the pricing itself, but not specific to you. It's specific to the whole group of people. Level term, which is probably the best product out there, probably the product most of y'all should be buying. It gives you a fixed rate for a number of years. 20-year level term is probably the most popular. 10 years pretty popular. 30 years was popular, but then the insurance regulators changed the reserve requirements for 30-year. And a lot of life insurance companies didn't like that, so they jumped back down to 20 years. But level term for a 20-year-old, 10-year, 20-year level term is really, really cheap insurance. It's just amazing how inexpensive it is. You can cover your family for a very low budget. Convertible term is you're buying term, but you have the right to convert it into permanent. Very few people do that, but when you get your job through your employer, they're going to provide you annual term insurance. But you have the right when you quit the job to convert that into permanent insurance, but you have to pay the premiums. Most people don't. Why? Because the only people who convert are in really bad health. And so if you're healthy, you're not going to convert to permanent insurance. But most of y'all will get convertible term through your employer, and most of y'all won't even know about it because the only people who ask are the ones that are quitting because they have serious health conditions and they want some insurance, and so they convert to the permanent. Industrial life, I don't think is much of a product anymore. They're very small policies. They're usually just set up to cover funeral costs. I don't know how much a funeral costs today, maybe $3,000, $4,000, $5,000. There's so many people getting cremated today versus getting buried. I don't know how your family is. Y'all probably don't have a conversation. Do you know your grandparents or great-grandparents, what they want? So, yeah, a lot of people are getting, in fact, there's a really bizarre, I don't know if I told y'all about this. Did I tell you about that PBS special on when people die and have no family? So they cremate them. And there's a video, I may have told the last class, there's a video of this, and they're pouring the ashes of 20, 30 people into the gravesite, and it's a windy day, and the ashes are just, and they show this highway next to it, and the people just driving right through the ashes, but they couldn't find any heirs, any relatives, and so you would think they'd be much more careful with the ashes, but they weren't. They were just dumping them in and blowing everywhere. But I don't know how much, how much it costs cremation versus a burial site. Who knows? We're running out of land. But let's say it's $3,000 or $4,000. That's a really, really, really small policy. The premiums look really low. They look low because the amount of coverage is really small, and they usually pay weekly. But if you look at it relative to the amount of insurance you're getting, this is actually a very, very expensive policy. These people would probably be better off just buying a regular policy, like a permanent policy or something, and just not doing this. These could be term, these could be perm. I have it here under term, just have it in place. So they usually be better off somewhere else. So this is more of a distribution system. This is insurance that's sold by door-to-door salespeople. And so that's why it's there. We're probably going to look at MetLife at the end of the semester. They probably have a little bit of industrial life. I just don't think it's that popular anymore. So because it's just so expensive now. Now, some of y'all hear about my least favorite insurance. This is one of my least favorite insurances. It's not top of the list, but it's up there in the top 6. Credit life insurance. You owe money on a car or on a house. This is insurance that if you die, will pay the remaining mortgage. So this is an unusual declining term insurance because as you pay down the debt, your coverage comes down with the loan. So it's actually declining. It's usually sold on a group basis. Now, I was on the board of a credit union at USA's credit union. I don't like this insurance. I think it's a ripoff. It's just so ridiculously expensive. But our credit union members kept asking for it every time they bought a car. Can I get this credit insurance? It's like, why don't you just buy regular life insurance? This stuff is so expensive. But they demanded, we had a group policy to cover our credit union members. So it didn't make sense to me. You're better off just buying regular term. Why? Because when you die, if you bought a house with a 3% mortgage and mortgage rates are now 9%, does your family want to pay off that mortgage? Wouldn't they want to keep paying at 3% and use that insurance for something else that make, they could invest in a CD making 7%. So why force them to have to pay off the debts? So get enough insurance to cover the debt, but then let them make the decision whether they pay off the debt or not. So it ties your hand. It's extremely expensive insurance. And then who's the beneficiary? The beneficiary is not your heirs. The beneficiary is the bank or the mortgage company. So it really just constrains the beneficiaries what they do with their money. But to me, the number one reason you don't like, when I was on the credit union board, I was like, have you looked at the premiums on this stuff? It's just ridiculously expensive insurance. So I don't, maybe only really, really unhealthy people are buying it, but that wasn't the sense I was getting. People were just saying, where I get my credit insurance. All right, so there's the different types of term insurance. Level term, if you're not sure, you need life insurance, go with the level term. It's the safest and easiest. So whole life or permanent insurance, just straight whole life. You see the word ordinary. This is going to be pretty important on the second exam. The word ordinary means you pay the premiums for your entire life. You never stop paying. You have to die to stop paying the premiums. Now, how far do you pay out the premiums? Most people say to age 100. Now that the mortality tables go out to 120, they probably still stop the premiums at 100. Just no one wants to be paying premiums after 100. But ordinary life, you just pay premiums forever. This is the policy my parents should have bought. Very, very simple policy. Then there's the limit pay whole life, the exact same thing, except for you don't pay the premiums your whole life. It stops at some time, like when you retire at age 65 or something. And what they figure is, hey, pay the premiums while you're working, have an income, but then when you retire, let that go away. The premium will be a little bit higher, but not as much higher as you think, because there's a lot of compounding of interest going on. And plus, a lot of people have died during that time anyway. So, the premiums are for the few people who live out to that much longer time. All right. I mentioned I didn't like credit life insurance. You want to know the next policy I don't like. You're going to notice as we go down this list, my likability reduces quite dramatically. And so here's the one. This is what my parents actually bought. I didn't like it when they bought it. And then when I saw it, I liked it even less. But universal life, this is a policy introduced in 1979 when interest rates were so high and we had that disintermediation that we talked about earlier. So we talked about disintermediation. There's a few things going on with whole life insurance at this time. So you have a $100,000 policy with a $20,000 cash value. Your life insurance company is paying you 3% on that $20,000. In 1980, you could make 15, 16, 17, 18% on a bank CD. So your insurance company is paying you 3%. You can make 18%. You can borrow this cash value and borrow at 3% and put it into the 18% CD. So you still have life insurance. If you die, you get the life insurance. So in this case, you have a $100,000 policy. So if you die, you have to pay back the $20,000 that you borrowed. But you get your 100,000, so you essentially net 80,000. But then you have that 20,000 sitting in the bank CD, making 18%. And of course, everybody's doing that. If you can borrow 3%, invest at 18%, you're going to do that. So all this money is coming out of life insurance companies. We already talked about the investment firms. So the product, this universal life, did not necessarily solve the disintermediation problem. What it did is it gave them a brand new, unique product so they could start all over again when interest rates were high. So what they're hoping was when people canceled or borrowed against their whole life, they would stick that money into the universal life, so at least it would stay in the company. So they're trying to become competitive there. Premiums, cash value, level protection can be adjusted up and down to meet the policyholder's need. And they did something unique here. Anytime you see the word universal, think the word unbundled. So with the whole life policy, with the ordinary whole life, you got one premium every month, you had to pay it. That premium would pay for your insurance and would pay for the cash value savings element. With universal life, they're now going to send you a bill, but it's going to split the insurance from the savings part. You have to pay for the insurance, but you don't have to pay the savings part. So it's unbundled. The insurance part is COI, cost of insurance. That must be paid to keep the policy in force. We're going to come back to this. This is actually a really big deal. There are two types of death benefits. I don't really care on this one, but there's some where the death benefit doesn't change. There's another one where the death benefit grows as your cash value grows. I don't really care that you know the difference between those, but the other thing they did with universal life is with the whole life, these two whole lives up here, if it was paying you 3% in cash value, that's what they charged when you took out a loan. But with universal life, what they started doing is saying, hey, if you borrow your cash value, we're going to charge you a higher interest rate than what we're paying on the policy. Your policy might pay 5%, but if you borrow money, we're going to charge you 6%. So they started penalizing people for borrowing their money. Universal life, this product was started about the same time I started my career, maybe a few years before. USAA was selling a lot of this stuff. It was a really popular product at USAA. And what I noticed was when they offer these policies, this is what their sales pitch looked like. Sorry, got a little too carried away. I don't know what happened to my 6%, but I could have gone larger, but I don't know what I did. So Bill Gates' fault as always. But this is what their advertisements started looking like. Does that look like life insurance? What does this look like? What are you advertising? Life insurance or an investment? This looks like an investment, doesn't it? With whole life, you never did this. Whole life, you just talk about the premium. Hey, you want a $100,000 policy, your premium is $50 a month. Well, they just talk about the premium. Here, they're showing you the interest rate. Well, we got a little problem here, don't we? Not only my ability to use fonts, but so let's do company A. Their cost of insurance is $50 a month, and the credit rate is 5.25%. Company B, their cost of insurance is $90 a month, and they credit 6.1%. Which is the better product? Would you rather pay lower cost of insurance to get a lower crediting rate, or higher cost of insurance and get a higher credit rate? And you're probably saying, I don't know the answer to that. And you should know the answer to that, right? You'd have to run some scenarios. And it also depends on when you die. What else does it depend on? Which of these two numbers can change? They both change. COI rises with age, and interest changes how often? How often can an insurance company change the interest they pay you on this policy? Every single month. If they got a big push to sell universal life in September, guess what month of the year their interest rate is the highest? Probably September. In fact, there's companies, if they have a big push in universal life, they'll offer 6.1%, and then they'll cut that to 5.2 the next month. So can you really compare these two policies? You would think the 90 might be worse. That's a lot higher. And it might be this firm's going to really cut its rate pretty quickly. They can cut their rate anytime they want to. In fact, I don't know if y'all heard the phrase bait and switch. I can't type bait and switch. Have y'all heard that before? You hear that a lot in life insurance. What does bait and switch mean? You advertise a 6.1% rate knowing you're going to cut it to 4% next month. You bait them in, you got it, and then once you got them, you switch it to the lower rate. TSAs are real popular products. They sell them to teachers. Guess what the highest rate for TSA is during the year? August. Why is that? It's kind of curious. That's when people have to make their elections and are looking, and you offer a 6.1% rate once a month and once a year, 1 month out of the year, and then you offer 4% the rest of the year. Yeah, I mean it's pretty bad. So is this advertisement actually telling you anything? It's only one part of the equation. That number can change to 4% next month. And the cost of insurance. Now, the cost of insurance is actually set at the beginning of the policy, but it rises with age. So they can't just increase that willy-nilly. They have to keep with the mortality tables, but it does go up with age. So what else happens with this? So there's another issue came up with insurance with Universal Life called vanishing premiums. You can probably look this up on the internet with the word lawsuits, because there are many vanishing premium lawsuits out there. MetLife pays $1.7 billion lawsuit. So what is vanishing premiums? So my mom got this vanishing premium. I wanted to sue the insurance company. Unfortunately, I didn't get her policy until all the lawsuits had already happened. So we essentially missed that. But what they say is at the sales pitch, they say you can pay the premiums for, say, 20 years, but then your cash value is so large, it covers all of the COI, so your premiums vanish. You have free insurance. That's what they said is, hey, you know what? We're paying you this 6% on your policy, and that cash value is going to grow so big at one point, you can just stop paying premiums entirely, and you got insurance for the rest of your life. The premiums just vanish. And what did the premiums actually do? Do you think they got sued because they told the truth? They left out one important word. And what word might that be? If interest rates stay high. Did interest rates stay high? No, they dropped dramatically. Were they paying 6%? So this policy is paying 6%. The sales agent says, you know what? If we keep paying you 6% for the next 20, 30, 40 years, at one point you're going to have this massive cash value and you won't have to pay premiums ever again. The person goes, wow, that's really good. But the person should say, well, but what if interest rates fall? That would be a good question to ask. But the sales agent never says if interest rates stay high. They just said, hey, based on what we know today, and in a few years, you won't have to pay premiums ever again. You'll have free insurance. It's like an incredible product. So let me show you what happened with my mom's product. So her premiums, I don't know exact numbers, but I'm pretty close here. For $250 a month. That was for both the cost of insurance and the savings element. So what that meant was maybe $70 for cost of insurance. The rest was going to savings element. Remember, she didn't have to pay the savings element, but she always paid the savings element. $250 a month. And she kept doing that. And then she got a letter in the mail. Your premiums are going to rise. Now, I said, well, wait a minute. I thought my premium was $250 a month. And they said, yeah, but your problem is your cost of insurance is rising fast. As the person insured was in their 70s and their 80s, the cost of insurance is rising. And your cash value is much lower than we thought it would be. Why? Because rates fell. So they thought 250 would be fine, but instead of paying 6%, they started paying 5% and then 4.5% because interest rates were falling. So my mom calls me and says, I keep getting these letters from what insurance was Allianz. They didn't buy from Allianz. Allianz bought the company that they got the insurance from. But she couldn't tell how much they're going to rise. So I got the policy. There's no way you could make heads or tails out of it. But the new premium, oh, let's see if I can remember this. What do y'all think? So essentially what was going to happen is her cash value was going to go to zero. So what was happening, she was paying $250 a month, but the cost of insurance was like $300, $400, $500 a month. So they're taking money out of her cash value to cover the rest. So she needed to pay the new premium. Any guesses here? I don't remember the exact number, but I can get it in the ballpark. You go from like 250 to 500, do you think? That'd be pretty sharp, a 100% increase. I think more than that, 750. All right, it's somewhere in the ballpark of 2,800. So my mom's like, okay, now what do we do? So we're insuring someone who's aged, has serious health problems. The premium's now $2,800 a month for a $140,000 policy. So we're going to pay, just someone do the math. What is that, about 30,000 bucks a year for a $140,000 policy? But the person we're insuring is very, very sick. What do you do? So that is a torturous thing to ask someone who depends on that life insurance because she didn't have any other coverage to help her out. And that happened from one year to the next, 250 to 2,800. It's just crazy, crazy, crazy. And so we sat down, me and my brother, he's a life actuary. We sat down and we finally decided I would take over the policy, I would pay the premiums. If the person died, she would reimburse me from the proceeds and then she'd get the proceeds. If not, I would take the risk because, and at age 96, the policy stops. So if he lives to 97, you get nothing. So are we going to pay? Now, what is this 2,800 bucks going to do every year? It's going to keep going up, right? Because it's the cost of insurance. So this is a horrible thing to do to any family. You see why they should have just bought the whole life? If she had bought the whole life, what would have happened? If she had bought ordinary whole life, her premium would be the same no matter what. They could never raise that premium. That's the policy. And so I don't know the math, but my guess is the math. If they had bought an ordinary whole life, the premium might have been, say, 280. They bought the U life, the premium was 250. So the whole life would have been a little bit more expensive, but they know that 250 is set forever. They don't have to worry about it. That's the policy they should have purchased. But they bought the U life. You see why I don't like this product. This is on the lower end of complexity, but it's really complex, especially when you get to the point where you got to make decisions where you're having these conversations of when are you going to die? So if you die in 4 years, I shouldn't pay the premium. But if you die in the next week or so, yeah, I should pay the premium. Horrible conversation to have with anyone. The person insured was very sick, but he'd also been very sick a decade before and survived. He was kind of a survivor. So it was pretty rough. He did end up passing away about a year later. And so I was reimbursed about 30,000 bucks, and then she at least got the 110,000 bucks, which she needed for her retirement. I mean, she's covered either way because we're going to take care of her, but still, it was a horrible decision we had to make. Salute. I'll tell you what, I also did because I did call a viatical company. We'll talk about that later. So there's something really, really important. If you have someone in their 70s and you're in this position, don't just cancel the policy. You always call a Viatical company and see what they will offer you. We'll talk about that later. So I did do that, and really fun conversation. I kind of did it just because I was curious how they work, and they're pretty aggressive. That guy called me every month. You want to do this? You want to do this? I was like, wait, I'm not so sure. And the equation got so complicated, I had to tell him, sorry, I can't do anything. But very active. This is another alternative that you have. But we're talking about decisions that are incredibly difficult for PhDs in math to handle. These are regular retail people without insurance backgrounds trying to make really tough decisions. So I don't like this policy. And it's one of the reasons why I really question if you can call this permanent insurance. If your premium can go from $250 a month to $2,800 a month, that looks a lot like renewable term insurance to me. And it's going to keep going up. The question I asked them, I should bring you the paperwork. I asked them, what will the cost of insurance be for the rest of this person's life? I want to know how high is that 2,800 going up? And that's what I should show you. You would not believe what they sent me. It could have been in some foreign language, and I would have. It was great, and I got a pretty good background in this stuff. I can understand actuarial terms, but it was ridiculous what they sent me. And essentially, they say we can't answer that question. I said, how can you not answer that question? But I want to know, is this going to go to 4,000, to 6,000, to 12,000? What's it going to do? I'm trying to make a decision about this policy. So, all right, any questions on that? Universal life, it's not as bad as it gets, but it's a pretty complicated product. It is unbundled, but most people probably just pay the entire premium every month just because it's kind of a hard decision to make. But if interest rates were to rise and the cash value got really large, you would have that option of not paying the savings amount and just letting the cash value pay your premium. It's just that these products were offered at the height of interest rates, and interest rates have been coming down since. And that's why companies were getting sued. Companies were being sued for telling people your premiums are likely to disappear. And with my mom's case, her premiums didn't disappear. They went up tenfold. And that's why firms were getting sued. It's like, wait, what you told me? My mom's a smart lady, but when she bought this product, she kept telling me, I bought an annuity. And I go, Mom, that doesn't sound like an annuity. No, it's an annuity. So smart as she is, she didn't even know she was buying life insurance. Why did she think it was an annuity? Because part of life insurance had a payout option that if the person dies, this is what will pay out. It sounded like an annuity. I was like, Mom, you don't have an annuity. You have a universal life policy. And she kept all the paperwork. My mom was real stickler for if someone did her wrong, she like, here, you lied to me. So she had her paperwork. It's pretty amazing what the salesperson told her. She doesn't like that salesperson anymore, and my mom generally likes everybody. So she felt really bad about this whole thing. What should she have done? She should have called her son who worked in the life insurance industry and her other son who was a life actuary, and she should have asked what to do, but she didn't ever do that. So they bought a universal life policy. Most universal life is sold on crediting rates, as we said. You see now what I was talking about, comparison shopping. There's just no way to comparison shop two universal life policies or three policies. You've got the cost of insurance, you have the crediting rate that can change every month, you have the policy loan rate that can change. There's a lot of stuff going on. It's really practical. And really the crediting rate makes it impossible because they can change the rate every month. So all you can do is look and see what they did historically. How well did they treat their customers historically, and maybe use that as a gauge. But other than that, you're at their mercy. There are minimums. That just makes it more difficult. This one might have a minimum, say, of 3%, and this one might have a minimum of 2.5%, which means they can cut their crediting rate down to 3. They can cut theirs down to 2.5. It's just one more bell and whistle that makes it really hard to compare these products. And think when we're selling these in 1980, you can't go back and test these historically because interest rate had never been that high before. So we're in a really, really unusual period of time. So remember, they're selling these things when interest rates are 15, 16%, telling people hey, wow, you won't have to pay any premiums if you make 16% the next 20 years. No one made 16% the next 20 years. The interest rates fell pretty dramatically. I don't know who got sued the most. I think almost everybody got sued. Here's another article. What is vanishing premium insurance? We were talking about mutuals last class. Money is Mutual of New York. What kind of company do you think they are, mutual or stock? You would think mutual, but you notice they're not Mutual of New York anymore. Now they're Money. Why? Because they went public. They're now a stock company, so they changed the name from Mutual of New York to Money. So yeah, it's vanishing premium insurance scam. Why is it a scam? Because you've got a salesperson making promises without anyone there listening in and scrutinizing what they're saying. The obvious thing to say is, hey, if interest rates stay high, this happens. However, if interest rates were to fall, your premium could go from 250 to 2,800. I think they should be required to say that, but they didn't have to say that. And so the person gets kind of stuck with it at the end. All right, we covered that. So is it really permanent insurance? It's generally classified as permanent insurance because it has a savings element, but the premiums can change quite dramatically. It'd be nice if this is as complicated as it got, but we're only on letter C. So what comes next? We add a new word, the word variable. When you see the word variable in insurance, you run for the hills. Insurance companies love variable products because they make a lot of money off of them. So that's one thing you can be sure. The product the insurance company and insurance agent is pushing is the product that does what? Makes you the most money and makes them the most money. I mean, you can kind of guess, right? So variable products aren't sold much anymore. Everybody's moved to variable universal life. And variable products, when you see the word variable, what is happening is the company is saying, hey, you know what? Instead of us making the investment decisions, we'll let you make the investment decisions. We'll give you a list of mutual funds and we'll let you put the cash value in the mutual fund you want to put it into. So that's a variable policy. So the policyholder now directs the savings element. With universal life and whole life, the company buys the bonds. And if the bond goes in default, the insurance company bears that risk. The insurance company bears all the investment risk. With variable products, if you put your savings element in the S&P 500 and the stock market falls 30%, you lose all that money. So the investor loses all the money if the market crashes. And what the SEC said is, okay, life insurance industry, you're now in the investment world. You're now selling a product that we regulate. And so that set up dual regulation. So your sales agents have to be both licensed to sell insurance in Texas and licensed to sell investments at the federal government level. So you have to take all those license exams. So it made more expensive. There was actually a lawsuit. I think it went to the Supreme Court over this, and the insurance industry lost that. The SEC won. It's still insurance regulated by the insurance industry, by the states, but it's also an investment product. So anytime you see the word variable, think dual regulation, think the policyholder takes all the risk. And in fact, with these products, and we'll see it later, the investments on these products don't even show up on the insurance company's books. They actually separate them off into a separate group of books because it's really not their risk. All that risk goes to the policyholder. Now, variable doesn't have the word universal life in it. So these have a fixed premium. So you have to pay the entire premium. They're just not sold much anymore. So then what the insurance industry said is, all right, we created a really complicated product. And then we created another really complicated product. What if we put those two complicated products together and sell variable universal life? So it's variable, so the policyholder has to make all these investment decisions. And it's universal such that they have to pay the cost of insurance, but they don't have to pay for the savings element. Again, Susie Orman. We can try Dave Ramsey. I don't know how to spell Dave Ramsey. I'm pretty sure he hates variable universal life. Yeah, this is missing Dave Ramsey. So is Universal Life, this is Universal Life. I'd be curious what he has to say. Someone go watch this video and let me know. Um, he does some things that I think, I agree with him on some things, but I think he has his hands in the cookie jar on the mutual fund side because he pushes mutual funds that are really horrible funds. And my guess is he's getting something out of that. Susie Orman has the same issue. Um, but generally, Dave Ramsey, Susie Orman don't like these kind of products for what I'm talking about. They're very complicated. The fees are really, really high. There's just better ways to save your money. If you need life insurance, buy life insurance. Don't combine your life insurance with an investment that you can't understand that's complicated. Um, these were really, really, really popular in the 80s and 90s because people wanted to be in the stock market, but they also wanted life insurance. So you could stick that savings element into the stock market and just let it ride. Endowment life is not all that complicated. I like endowment life, but essentially what it says, and we'll price endowment life. A pure endowment, what a pure endowment says is you buy the policy if it's 10 years. If you die, you get nothing. But if you're alive at the end of the 10 years, you get the money. I actually love those. I'm going to show you how those can be a really powerful tool later when we talk about longevity insurance. Most endowment life, though, what it does is if you die, you get the life insurance. And after end of 10 years, you're still alive, you get the life insurance. So you get it whether you live or die. And that's when the tax code said, no, that's really not life insurance. You're getting the money either way. We're going to tax that like it's a regular investment. So if you die, the money comes in, whoever receives the money is going to have to pay tax. They don't pay tax on the entire premium. So if you pay $50,000 in premium, all you're going to pay tax on is the investment gain part of that, what you got over and above um, the insurance part of it. It's pretty complicated tax treatment, so that's maybe one reason not to buy these things because the tax treatment can be pretty serious. But remember what I said, life insurance companies have a lot of tax people and they help their policyholders understand the tax consequences on stuff like this, where it's kind of built into the product. They have those records so they can send you a statement because they got to send it to the IRS. So that's endowment. We'll get in more endowments. I do love them for longevity purposes. And in joint and survivor life insurance, this is when the life insurance depends on more than one life. So there's the first to die policy. Obviously, we're talking about two spouses. If one dies, the first to die, it pays life insurance to the survivor. This might be a case where maybe one spouse has a pension, and if they die, that pension goes away. So when they die, the other person's going to get the life insurance to cover them that's first to die. The second to die might be, okay, the first person dies, we don't get the life insurance. When the second one dies, we want the life insurance help pay state taxes and probate and those kind of things. So we don't need the life insurance after the first person dies. We need it after the second one to help cover all the legal costs. Now, when we price insurance, we're going to price most of these. We're not going to do universal life and variable price life, but we will do an endowment. And then my little brother, I go, I want to do joint life. I want to price joint life in my life insurance class. And he says, no way you can do that. So of course we're going to do that because my little brother says no way. So we will price joint life insurance. I'll show you how it works. It gets a little complicated because you have to have two lives off the mortality table. But if you remember your joint probabilities from your statistic class, if any of you don't, we'll relearn them. It's not that complicated. And joint and survivor can be permanent. It can be term. So some of these can kind of go in either one. And there's all different type of variations. When we price life insurance on the exam, we're going to cover all of these. When you first see it, you're going, wow, that's complicated. And then you're going to discover after we do about 6 or 7 policies that we're doing the exact same thing over and over again. Only thing it changes is the dyers, the livers, and the premium payers. And once you figure that out, it's just this kind of cash flows with the mortality table. So most students have no trouble with them. And in fact, what I do on the final, and you'll see this, is I create the craziest, most ridiculous life insurance policy there is, and I have you price that just to see if you know how to handle the mortality table. So it might say you're alive at 53, you get the life insurance. But if you're alive at 54, you don't get anything. But then if you die at 57, you get something. But then if you die at 60, you got, I make it, but it's, if you understand mortality tables and discounted cash flows, they're actually pretty simple policies. Some life insurance, especially on the permanent side, not sometimes on the term side, but on the permanent side, are participating policies. So what the company says is, okay, there's a few things we're looking at. When do people die? What are our expenses? What are our investments making? So if fewer people died than we thought, we can give some of that money back to the policyholders. If our expenses were lower than we thought, we can give some of the money back. If we made more in our investments, we can give some of the money back. That's a participating policy. And what most life insurance companies do with permanent is they actually overcharge some intentionally, thinking they'll give some of that money back. It's a protection for the life insurance company. Let's assume people die 20% more than we thought. And then they die exactly what you thought. Then you got an extra 20%, you give that back as a dividend. And you get it back essentially tax-free, because the IRS just considers that a return of your premium. They don't consider it an investment return. It could be an investment return, right? If they did really good on investments, you could be getting investment money back for free, tax-free, but it is tax-free. Generally, the dividends come in 3, 4, or 5 years into the policy, you start getting dividends. You might say, well, no company's going to do that. They'll just say, hey, you know what, things weren't that good. But companies that do this take it very, very seriously. I was on the pricing committee. Well, I wasn't a member, but I sat in the price committees at USAA. And the guy, oh, what was his name? I can picture him. Robert something. He was in charge of participating policies, and he took no arguments. It's like, we're paying this dividend. I set this policy up. We assume this mortality. We got this mortality. We're paying, and the committee's like, well, couldn't we just pay X? No, you're paying Y. That's what it says. So he was like, no compromise. We told our customers we will pay dividends if the policy did well. The policy did well. We're paying the dividends. You're not ripping these people off. And I don't know if they had to agree with him, but I think they were scared of him because he was adamant. This is the ethical thing to do. So a lot of companies, yeah, if you buy participating policy, and historically they have paid pretty good dividends, they probably will pay pretty good dividends on these policies. But you're limited risk there that they may not do that. I'll just tell you this story that happened to my brother. We'll talk about this company at depth. I'm not going to tell you the name yet, but you're going to see the name here very soon. It was a company that the insurance industry really hates. But this company came to my brother. My brother had a term policy. So he had a State Farm term life, and it was participating. And his premium was, say, $200. This company, let's just call it ALW. I'm giving it away there, but okay, ALW. They had a level term. This was, yeah, level. They had a level term, non-participating. And they're trying to get my brother to cancel his State Farm policy and buying from them. And their argument was, this is a participating policy. And they had an article that said participating policies rip their customers off. And that's true. There probably are some participating policies that do. Not all of them do. And they say, buy our policy because we're non-participating. Our premium is $300. Now, this is fixed. This is fixed, all right? So State Farm, he'll pay $200 a month for 10 years. If he does ALW, he'll pay $300 for 10 years. So what's the only thing that could change? State Farm might pay him some of his premium back. So what's his worst case with State Farm? $200. But he might get dividends. They can't say with participating policies, things were worse than we thought, so we're going to charge you more. They can't do that. They can only give them a dividend. What's the best ALW can do? That's their best and their worst. That's all they can do. How many would recommend my brother switch policies? Is there any way ALW, I'm almost saying the name of the company, is there any way ALW could be better than State Farm? It's impossible. There's no way. And yet they sat there with a straight face. I was watching their faces and said, you need to switch because we have an article that said these policies can be bad. And said, well, State Farm, he's had this policy with State Farm. They've never paid a dividend. So let's just assume it's non-participating because they're never going to pay a dividend. They might, there's a chance they could, but he's still paying $100 less a month. He's going to pay with you. Why would he do that? Do you see why commission salespeople? I mean, it's a little shady. Do you think they knew this was a stupid argument? I'm not even sure they did. It's kind of crazy, but this company has a reputation for having the best salespeople. And I know they have the best salespeople because my history teacher in high school was working for this company and he was selling us life insurance in our senior year, no, his government class. He wasn't a very good government professor, but he was a very good life insurance salesman. He worked for this company. We'll talk about them. This is actually a pretty important company. So participating, I think there are some companies that participating makes it a little complicated because their premiums may be slightly higher, but historically they've done a good job of paying dividends. And if that's the case, you might go with the company you trust. So there are some firms out there like USAA, like State Farm, like MetLife. They treat the participating policyholders pretty well. And there's a good chance you'll end up better, but it's just one more thing you got to look at to try to figure out what's the better policy. It just complicates things. So just one more complexity, making comparison shopping. You notice I keep talking about comparison shopping. You're going to talk about comparison shopping in 2 of the essay questions on this exam. One of them is on the ethics, and the second one is comparing term to perm insurance. Comparison shopping is a huge issue for me. If you want to bring this up in an interview, it'd be really, really touchy. If you do it with Northwestern Mutual, they might be a little touchy on that. I'd say, it's important to me that the customer is able to tell if the product they're getting is a good deal or not. So I'm real leery of working for a company whose products are so complicated, the customer has no chance. They probably won't hire you if you say that, but you could certainly bring it up. But that to me is the most straightforward. You buying insurance, that should be your obvious question. How can I tell your product's better than the competition? Prove it to me. And I don't mean prove it to me by saying a bunch of stuff that sounds intelligent where it's all gobbledygook. I mean, actually prove it to me. And the advantage you have over a typical retail investor is that you're smart. The average retail person is not sure they're so smart. So someone's using a bunch of gobbledygook, they're going to probably go, yeah, I see what you're saying, because they don't want to seem stupid. You have the advantage when someone's saying stupid stuff, it is, and you can say, so I remember the CEO of USA, smart guy, if he didn't understand something, his ego had no problem saying, I don't know what you're talking about. I have no clue what you're talking about. You're going to explain it again. That's what you got to be like with life insurance. I don't know what you mean. That doesn't make sense to me. Explain it to me again. Better yet, I'm bringing in my 10-year-old nephew. I will buy the product if he can explain it to me. If you can't explain it to him so he can explain it to me, I'm not buying it, and see what would happen. They'll probably run out of your house screaming, but that would not be such a bad thing. Oh man, I don't know if I really want to. We'll come back to this one because I want to make sure we don't get too far. This one's interesting, but if we miss it in the class, we can get to it. What I want to show you is where we're going next. So this guy, Art Williams, his actual name is A.O. Williams. That sounds familiar at all? We call him ALW if you wanted to. So this guy, Art Williams, you can look him up, very famous person. You can even do A.O. Williams prison. He has his own Wikipedia page. How many of you have your own Wikipedia page? Can you create your own Wikipedia page about yourself? Can you really? Does it get deleted like a week later? So Anyway, he's hated with intensity by the insurance industry. So what he did, remember in the late 70s, insurance industry is really, really struggling. And Art Williams comes in and says, forget permanent insurance, forget variable life, universal life, whole life, forget that stuff. Just buy term. And he came up with this phrase, buy term and invest the difference. And you're actually going to do graphs to show what he means there. And this revolutionized insurance industry. So at a time when this insurance industry was struggling on whole life and creating these new products so they can be competitive, he's coming and saying, just throw all of that out. Only buy term, which I would agree with him, only buy term. What did he say? Buy term from me and invest the difference with me. I agree, buy term and invest the difference. I don't agree with buy term from him and invest the difference with him. Why? Because his insurance was grossly overpriced and his investments were heavily fee-based because they made a lot of fees. So he had horrible life insurance and horrible investments. But he revolutionized it. How did he revolutionize it? With a good argument, bad products, and incredibly good salespeople. Isn't that sad that that's going to be a successful insurance industry? Bad products, good argument, great salespeople. That's what he did. He even got my government professor, teacher to sell this stuff. So what we're going to do, and this is the essay question, I'll set it up here. What I did is I went to Art Williams' website when it still existed, and I took all of his arguments for buy term and did invest the difference. I didn't organize them. I just put them down. And I used to use a textbook in this class, and it is so skewed toward the industry. I can't use it anymore. It's just too biased. He argued for buying permanent. So I just took all of his arguments and put them down. So you got to organize this, all right? So I'm going to show you the arguments. There's a lot of overlap, like they say A, but they say B, but then they say A to his B. So that's what you're going to do. And then you're going to have some graphs that are going to explain buy term and invested difference, all right? So all of this is in the class notes. I do not write the essay question for you. You're going to have to figure it out with this jumble that I'm going to give you, but I'm giving you the arguments that they give. All right, these are the graphs for exam one. They kind of look similar to the other one, but they're not. They're very, very different graphs, all right? So we'll start there next class, and we'll get into it, and you'll see these arguments, interesting arguments. All right, I'll stop it there.